Good morning. I have come with the explanation for income from house property, computation of income from house property. This is called Module 7. Module 7.1 I have already explained. That is the theoretical concepts of computation of income from house property. Now this Module 7.2 I am going to explain how you compute net annual value. Now, expected rental value, annual rental value, net annual value. These are important concepts in computation of income from house property. So, these three values. What the previous module I have explained what is municipal rental value, fair rental value, real rent, standard rent, all that. Then I told you with each module I will explain these concepts with the help of problems. So, this module I am going to explain 8 problems. In problem number 2, I have explained 4 situations. So that means actually 12 questions we are explaining in this module. So with this, you will be able to understand how you calculate expected rental value, annual rental value, and net annual value. So once we know that, then we can go to the computation of income from let out house property, income from self-occupied house property, pre-construction interest, and the total computation. This is how I have designed the modules for income from computation of house property. So with this module, you will be able to understand the basic concepts. I told you this chapter is very simple. So this I have explained it properly so that you will not get any confusion and this concepts will be very clear to you. So that is the advantage of this module. So this wishing you the very best, good learning and good understanding, and tell me the feedbacks, any suggestions, any questions, you can raise it anytime. So I hope that you all are keeping fine and safe and healthy, all your family members also. So my prayers are with the family members and for all my students for this, if they are affected, for their speedy recovery or to control the situation itself for the country at large. I am praying and I hope that all the countrymen in India, we are praying for that. So coming to the module, we are going to learn computation of net annual value with the help of problems, and this I have explained with the help of PowerPoint presentation. The first problem, Mr. A has a house in Bangalore which is let out. Its municipal rental value is 1,08,000 per annum and fair rental value is 1,20,000 per annum and the standard rent is rupees 1,02,000. Compute expected rental value. So in this problem, 3 values are there. Municipal rental value is there. You know that what is municipal rental value? That is the value fixed by the municipal authorities. Fair rental value, that value that can fetch in the similar accommodation. You cannot reduce the value compared to other buildings, whatever the rent they are getting, or you cannot increase also. So there will be a standard. So that is the fair rental value. What is the rental value that can fetch in the locality? And the standard rent is also the rent fixed by the authority. So 1,02,000 is the standard rent. So the expected rental value. This is the first step. From expected rental value, we will derive at the annual rental value. From annual rental value, we will come to the net annual value. So this is the first step and we are going to do that. So the expected rental value we are going to compute. So table showing the computation of expected rental value when standard rent is given. Next problem is when standard rent is not given. So that is why the distinction. So first computation is when standard rent is given, you have to think that, you have to remember that you have to compare the values of municipal rental value and fair rental value. So that is what I have mentioned. Point A is municipal rental value, point B is fair rental value. Now C is between A and B, whichever is higher. That value you have to take. That is 1,20,000. Now the next value you have to compare with standard rent. So standard rent is 1,02,000. Now between C and D, whichever is less, that will be the expected rental value. So that is the 1,02,000. So here expected rental value is 1,02,000. Now problem 2. Mr. A has a house property in Bangalore which is let out. Its municipal rental value is 1,08,000 per annum and fair rental value is 1,20,000 per annum and the real rent is 1,02,000. Compute expected rental value. So here you have to remember that previous problem standard rent was there. Here standard rent is not there. Real rent. Real fair rental value meaning this is the rent that can be fetched in a locality. But real rent will be different. Real rent, see that is the rent actually received by the landlord. So here real rent is given and standard rent is not given. So what will be the value? Compute the expected rental value. So here all the three values you have to take. A, B and C. Whichever is high, that will be the expected rental value. So here you are getting 1,20,000. When standard rent was given, the value was 1,02,000. So you learn two computations. One is when standard rent is given and second one is when standard rent is not given. So this computation is different. You have to see the difference. Now problem 3, from the following details, find out the expected rental value. So this I have divided into 4 situations. Situation A, situation B, situation C and situation D. So it's like doing 4 problems. So municipal rental value is there, fair rental value is there, real rent is there and standard rent is there. So situation A, only municipal rental value, fair rental value and real rent is there. So just like the previous problem, standard rent is not there. So which one will be the highest value only we will take. So MRV, FRV, real rent, whichever is higher we will take. So 3 values you are comparing and whichever is high 1,50,000. So that is the situation A. Now situation B, expected rental value, situation B, standard rent is there. So you have to remember that here 4 values are there. So far we have worked out municipal rental value, fair rental value, standard rent and real rent. 4 values are there, how you do the calculation. So here municipal rental value and fair rental value, whichever is higher you have to take. So first is municipal rental value you wrote, fair rental value you wrote. So between A and B, whichever is high, 1,20,000. Now you are writing standard rent. Standard rent is 1,44,000. So between C and D, whichever is less. See, this was the first problem. You remember standard rent is given. Whichever is less, we will take it as the expected rental value. So it is 1,20,000. Between 1,44,000 and 1,20,000. 1,20,000 is the value. Now real rent. Real rent is the rent actually they received. 1,08,000. So between E and F, whichever is high, we will take as the expected rental value. So that is 1,20,000. So now you have learned 4 values are there. Municipal rental value, fair rental value, standard rent and real rent. So this is how you calculate. Now coming to situation C. Here also all the 4 values are there, how you do the calculation. This is just to make you thorough with the calculation. So between municipal rental value and fair rental value, whichever is high, to 90,000. Now compare with standard rent, whichever is less. So 84,000 and 90,000, 84,000 is the expected rental value. Now we are comparing with the real rent. When real rent is there, again one more clarification to specify which value is the expected rental value. So real rent is 80,000, whichever is high will be the expected rental value. So that is 84,000. Comparison is between 84,000 and 80,000. Expected rental value is 84,000. Now situation D. Table showing the computation of this, also 4 values are there. Just the repetition, just to practice and do the make it thorough. So municipal rental value and fair rental value, whichever is high, you are taking that value. Comparing with standard rent, then 2,30,000 you are getting. Between C and D, whichever is less, that is the expected rental value. That is 2,30,000 you got. Now when real rent is there, you have to compare with real rent. So real rent is 2,40,000. So last step is whichever is high is the gross annual value. So that is 2,40,000. So here 2,40,000 you got. Now find out the gross annual value. Gross annual value we are comparing. See that previous module I have given one statement for how to compute that. Step 1, step 3, step 4, step 5. 5 steps. In the first module the format is there. Now we are going to do the problems. So 2 things are important here. Unrealized rent will be there and vacancy will be there. Unrealized rent meaning you have to remember that tenant is there. In the last module also I have explained that. Tenant is there in the house property. Tenant is occupied that, but he is not paying rent due to any reason. Now this itself you can take lockdown situation. Most of the people lost their job and all. So there you have to remember that if they lost the job and all, they may not pay the rent. Sometimes they may not be able to pay the rent. So that is unrealized rent. Vacancy is different. Vacancy is house is not occupied by anyone. So that meaning now it's locked down. Everywhere you can see the board, let out, sale and all. So if nobody is there to occupy the flat, then it is, or the house property, then it is vacant. So vacancy meaning nobody has occupied. Unrealized rent meaning tenant is there but they are not paying rent due to some reason. So here the problem is fair rental value is there, municipal rental value is there, standard rent is there, annual rent is there. See, annual rent and unrealized rent. Condition satisfied. Condition satisfied, you don't have to worry about that. See, condition satisfied meaning income tax officer has accepted the conditions to accept the unrealized rent. Unrealized rent meaning the landlord will claim that this month due to some reason, the reason they have to convince the income tax officer and the commissioner, and they will say that this is unrealized. So he has to deduct, he can deduct the from the annual rent. In this case 10,300 minus 1,000 you can reduce. Then only you will get the actual rent received, because 1,000 rupees landlord has not received. Similarly in other situations also. So here you have to remember that unrealized rent and vacancy we have to adjust if you have to get the gross annual value. Now table showing the computation of gross annual value, or GAV, short form we are using. So expected rental value, you know how to calculate that. So I am taking it. Municipal rental value, fair rental value, whichever is high, compare with standard rent, whichever is less. And if real rent is there, then we will take the whichever is the higher value. So that first step is the values which we calculated, and we learned so far how to do that expected rental value. Now rent actually received or receivable. So here you have to remember annual rent minus unrealized rent. I told you unrealized rent condition satisfied meaning we have to adjust that. So 9,300. All the situations, whatever the value given as unrealized rent, we have to reduce from the actual rent. So then you will get the values. Now step 1 or step 2 value, whichever is higher. So compare those values, 10,700 or 9,300, 10,700. Next is 8,800 or 9,200. It's 9,200. Next is 8,800 or 7,600. 8,800. Now 10,700 or 9,400. 10,700. Next is 10,700 and 8,700. It is 10,700. Now vacancy is not there in this question. Full 12 months the house was occupied by the tenant. Now gross annual value meaning step 3 value minus step 4 value. So here is no vacancy allowance. So step 3 values will be the gross annual value. Now compute the gross annual value or GAV. One more problem I have given, but only thing here that changes, here vacancy allowance is there. Vacancy allowance we have to adjust. Vacancy allowance also we have to adjust. So this is what the new adjustment in this problem. So what we are going to do this, expected rental value you have to calculate. Now you have learned how to do that. Municipal rental value, fair rental value, standard rent and real rent. You know how to calculate that. Now rent actually received, that you have to remember, meaning if unrealized rent is there you have to reduce that value. That also now you know that you will get these values. Now step 1 value or step 2 value, whichever is high. So compare 62,000 and 65,000, higher value 65,000. 62,000 and 61,000, higher value 62,000. 68,000 and 68,000, same value, there is no change. So you will get 68,000. 1,15,000 and 71,000, it's 1,15,000. Now it's 1,15,000 and 70,000, 1,15,000. Now if vacancy is there, you have to reduce from step 3 minus step 4. So that meaning 1,000 is vacancy. Landlord suffered a loss of 1,000 rupees in the first 4 situations. So 1,000 rupees you have to reduce. So that meaning gross annual value will be 65,000 minus 1,000, 64,000. 62,000 minus 1,000, 61,000. 68,000 minus 1,000, 67,000. 1,15,000 minus 1,000, 1,14,000. 1,15,000 and nil. So that is 1,15,000 itself. So now you know how to adjust unrealized rent and vacancy allowance. Now we are coming to compute the annual rental value. So expected rental value first you computed, then gross annual value computed. Now we are coming to annual rental value. So annual rental value, municipal rental value is 4,80,000 per annum. Compound rent received. See, when I explained the first module also, I have explained that compound rent meaning, see, sometimes tenants will not pay the maintenance charges when you are saying you're staying in the apartment. So this will create a problem for the landlord if they're not paying. So they will collect the compound rent. Compound rent meaning including the maintenance charges. So here in this case, lift and some maintenance charges paid by the owner. That meaning 5 lakh minus 60,000. 4 lakh 40,000 is the actual rent received by the owner. So here you have to remember that. Compound rent. See, it's not rent received. All the problems so far we have given rent received. Now it is the compound rent received. Next, you have to remember salary of common gardener and watchman paid by tenants to the owner, 5,000 per month. So this amount will go to income from other sources. It's not for house property. So 5,000 per month he is collecting. So 5,000 into 12, 60,000. But actual expenses incurred by the owner during the current year is only 42,000. So 60,000 minus 42,000. 18,000 will go as his income from other sources for this computation. That has no relevance for our computation for income from house property. Now table showing the computation of annual rental value. Actual rent received 5 lakhs less cost of common facilities. I told you this is compound rent received. That is tenant has paid including maintenance. 60,000 will go to the association. Actual rent received by the owner is only 4 lakh 40,000. So municipal rental value is 4 lakh 80,000. Actual rent received or municipal rental value, whichever is high, will be the annual rental value. So it is 4 lakh 80,000. Now problem number 7. Compute the annual rental value for the assessment year 2021. Municipal rental value is there. Standard rent is there. Unrealized rent is there. Date of completion. So here you have to remember that 31st July they completed. So from August only they have occupied. So date of letting is from 1st September. 1st October. 1st October meaning 2 months it was vacant. August and September it was vacant. So 2 months it was vacant. And it started from October. October, November, December, January, February, March. 6 months is they have got the house property. So here municipal rental value 84,000 into 12. 8 months. The completion, house property is completed by July. So 8 months you will get August, September, October, November, December, January, February, March. So we have to reduce the value to 8 months. It's completed in July. So from 1st August onwards we have to take the value. So it is 84,000 per month. So 10 lakh 8,000 into 8 by 12, 6 lakh 72,000. Now fair rental value also same, 90,000 per month into 12 into 8 by 12, 7 lakh 20,000. So now you know that to calculate expected rental value, municipal rental value or fair rental value, whichever is high. So whichever is high, then whichever is high is 7 lakh 20,000. Now you have to compare with the standard rent. Standard rent also you have to reduce it to 8 months. Standard rent value is 6 lakh 96,000. Now between point C and point D, whichever is less. So we are taking 6 lakh 96,000 is the expected rental value. Now real rent is 80,000 into 8 minus 80,000 into 2. 2 months they were not, house was vacant. So 6 lakh 40,000 minus 1 lakh 60,000. You will get 4 lakh 80,000. Between D and F, whichever is high. So you will get 6 lakh 90,000. Now less loss due to vacancy. So here 80,000 into 2, 1 lakh 60,000. So annual rental value is 5 lakh 36,000. So this is how you calculate. Now the last problem, now you calculate net annual value. So Mr. D furnishes the following details and compute net annual value. So first is calculated expected rental value, annual rental value and net annual value. So these are the three important first step in computing house property income. So this you will learn automatically. Now itself it's clear to you when you are getting different values how you arrive at this. Rent received 1,75,000, municipal valuation 1,60,000, fair rental value 1,70,000. So municipal taxes 1,72,000. Now municipal taxes 12% of municipal rental value and 2% of municipal taxes as sanitation charge. Now how you do this? Municipal rental value is 1,70,000. Fair rental value 1,72,000. Standard rent is 1,60,000. Rent actually received is 1,75,000. So higher value is annual rental value. Between municipal rental value and fair rental value, whichever is high, you have to take 1,72,000. Between standard rent and this value, 1,72,000, whichever is less. So it is 1,60,000. Between rent received and this expected rental value, whichever is high, that is the annual rental value, that is 1,75,000. Now from annual rental value, you have to reduce municipal taxes. So municipal taxes 12 by 100 into 1,70,000. It's given that 12% of municipal taxes. So it is 20,400. Now sanitation surcharge. See, sanitation surcharge, that also is allowed to deduct from annual rental value. See here in Karnataka and all, what is the garbage collection? They are collecting certain percentage, that and also we can reduce. So here it is sanitation surcharge 2 by 100 into 20,000 on municipal tax 2%. So you are getting 408. So 20,400 plus 408, you will get 20,808. So net annual value is 1,54,192. These are the problems I wanted to explain. Actually, we explained 8 problems. And one problem I have divided into 4 situations. So actually, we have worked out 12 problems. And now you know that what is expected rental value, how to calculate when standard rent is given and standard rent is not given. Then real rent is given, real rent value is given. Then annual rental value, how you calculate, gross annual value, how you calculate, and net annual value, how you calculate. So this is important calculation. Once you know net annual value only, we will start the computation of income from house property. So these are just the basic steps. When you do 2-3 problems, automatically you will learn. You can directly go to annual rental value and minus municipal taxes. Then you will get net annual value. This is how we are going to do that. So please remember that this computation is important, though we have worked out only simple problems. This is the base for computing income from house property. So please remember that this is very, very important and you will learn from this. Because this, when you learn this, only then you can go to the next module. Next module, I am going to explain how to compute income from let out house property. So this you can learn only with this. So this first module 7.1, I have explained all the theoretical concepts. This formats for computation, all that, how to calculate gross annual value, how to calculate income from let out house property, how to calculate income from self-occupied house property, all the formats are given. Now slowly, one module we are doing the problem. So this is also important and I'm wishing you all the best for a happy learning. So simple learning, systematic learning. So wish you all the best and please give me your feedbacks and suggestions if you have any suggestions. Okay. Thank you.